Are you unknowingly signing away thousands in potential earnings with your certificate of deposit strategy? Most people hear about CD ladders and jump in without understanding one critical distinction, a mistake that could leave your money locked in suboptimal rates while others are cashing in. By 2026, with economic shifts, this error will be even more punishing. Imagine expecting a steady 5% return, only to realize you're effectively earning 3% because of a simple oversight. This isn't just about missing out on a little extra cash. It's about making a fundamental error in how you structure your safe investments, an error that erodes your purchasing power over time. The key is knowing what kind of CD you're actually buying, and it's not always obvious. We'll reveal this hidden pitfall and how to avoid it, starting right now, because your financial security depends on it. So, what exactly is a certificate of deposit? At its core, a CD is a savings account that holds a fixed amount of money for a fixed period of time at a fixed interest rate. You're essentially lending money to a bank for a set term, say 6 months, 1 year, or 5 years, and in return, they pay you interest. The catch? Your money is locked up until maturity. If you withdraw early, you'll likely face a penalty, usually a forfeiture of some interest. CDs are FDIC insured up to $250,000 per depositor per institution, making them one of the safest places to park your cash. They offer predictable returns, which is why they're popular for conservative investors or those saving for a specific short to medium-term goal. But even with this safety, there are nuances in their structure that can significantly impact your returns, especially the one we'll dive into next that most people overlook. Why bother with a CD ladder instead of just one long-term CD? The primary benefit of a CD ladder is liquidity and flexibility in a fluctuating interest rate environment. If you put all your money into a 5-year CD at 3%, and then rates jump to 5% next year, you're stuck. A ladder solves this. Instead of one large CD, you break your investment into several smaller CDs with staggered maturity dates. For example, if you have $10,000, you might put $2,000 into a 1-year CD, $2,000 into a 2-year, $2,000 into a 3-year, $2,000 into a 4-year, and $2,000 into a 5-year CD. This way, a portion of your money matures every year, allowing you to reinvest at current rates. This provides a balance between higher long-term rates and access to your capital, but there's a specific type of CD that can sabotage this entire strategy, which we need to discuss now. Here it is, the critical mistake. Most beginners assume all CDs are the same, but they're not. The pitfall is unknowingly investing in a callable CD. A callable CD gives the issuing bank the right, but not the obligation, to call or redeem your CD before its maturity date. Why would they do this? If interest rates fall significantly after you've locked in a high rate, the bank can call your CD, pay you back your principal and accrued interest, and then you're forced to reinvest at the new, lower rates. This completely defeats the purpose of locking in a high rate and destroys your CD ladder strategy. You think you're getting a 5-year commitment, but the bank can pull the plug on you early, leaving you exposed to lower rates. Always confirm your CD is not callable before investing. This single oversight can cost you thousands in lost interest over time, and it's a detail many institutions don't highlight up front, which is why you need to be vigilant. Let's put this into perspective with real numbers. Imagine you invest $10,000 in a 5-year callable CD, paying 5% APY. The bank offers a slightly higher rate for callable CDs to entice investors. For 2 years, you enjoy those returns, earning $500 in year 1 and $525 in year 2. But then, interest rates drop significantly, let's say to 3%. The bank exercises its call option. They return your $10,000 principal plus the $1,025 interest you earned. Now, you have to reinvest that $11,025 at the new, lower 3% rate for the remaining 3 years. If your CD hadn't been callable, you would have continued earning 5% for the full 5 years. That means instead of $1,650 in the last 3 years at 5%, you'll only earn about $992 at 3%. That's a direct loss of over $650 in interest, just on a $10,000 investment. Scale that up with more money, and the cost of a callable CD becomes substantial, proving why avoiding them is paramount. Now that you know what to avoid, let's build a proper CD ladder. First, determine your total investment amount. Let's use $20,000 as our example. Next, decide on the number of rungs in your ladder and the maturity intervals. A common approach is a 1-2-3-4-5-year ladder. This means you'll divide your $20,000 into 5 $4,000 segments. You'd invest $4,000 in a 1-year CD, for $1,000 in a 2-year CD, and so on, up to a 5-year CD. Make sure all these CDs are non-callable. As each CD matures, you take the principal and interest and reinvest it into a new 5-year CD. This continually rolls your money into the highest available long-term rates, while ensuring a portion becomes liquid annually. This systematic approach allows you to capture higher long-term rates while maintaining annual access to a portion of your funds, a truly elegant solution for managing interest rate risk. But there's a crucial timing element to consider. Timing your reinvestments is where the CD ladder truly shines, especially in a dynamic rate environment. When your 1-year CD matures, you reinvest those funds into a new 5-year CD. The beauty is that you're always taking advantage of the current interest rates for long-term deposits. If rates have gone up, you lock in a higher rate. If they've gone down, you're still earning higher rates on your existing longer-term CDs that haven't matured yet. This strategy smooths out the impact of rate fluctuations over time, providing a more stable average return than if you were to simply buy one short-term CD repeatedly. It's a continuous cycle, ensuring that as each rung matures, you're extending your ladder by adding a new longest-term CD at the prevailing rates. This adaptability is critical for maximizing your returns over many years. But where should you even buy these non-callable CDs? So, where do you find the best non-callable CDs? You have a few main options. First, traditional banks and credit unions. While convenient, their rates are often less competitive than online-only banks. Online banks like Ally Bank, Marcus by Goldman Sachs, or Discover Bank typically offer higher APYs because they have lower overhead costs. Always compare their rates. Second, brokerage firms like Fidelity, Schwab, or Vanguard also offer CDs, often from a variety of issuing banks. These are sometimes called brokered CDs. The advantage here is convenience. You can manage your CDs alongside your other investments in one account. Crucially, when buying through a brokerage, always verify if the CD is callable. They will clearly label it. Remember, FDIC insurance applies to each issuing bank. So even if you buy multiple CDs from different banks through one brokerage, each is individually insured up to $250,000. This flexibility gives you plenty of choices, but you need to understand the why behind rate changes to make the best decisions. Why do CD rates change? And how does this impact your ladder? CD rates are heavily influenced by the Federal Reserve's monetary policy, specifically the federal funds rate. When the Fed raises rates to combat inflation, banks typically increase their CD rates to attract deposits. Conversely, when the Fed cuts rates to stimulate the economy, CD rates tend to fall. Economic outlook, inflation expectations, and demand for loans also play a role. Your CD ladder is designed to navigate these changes. In a rising rate environment, your maturing CDs get reinvested at higher rates, boosting your overall yield. In a falling rate environment, your longer-term CDs, locked in at higher rates, continue to provide attractive returns until they mature. This inherent flexibility is why the ladder is a superior strategy compared to a single CD, but there's a common myth about CDs that can lead to poor choices. Here's a common myth. CDs protect you from inflation. While CDs offer safe, predictable returns, they don't always keep pace with inflation. If inflation is 4% and your CD pays 3%, your purchasing power is actually decreasing. This is a critical point often misunderstood. CDs are excellent for capital preservation and generating modest, guaranteed income, but they're not designed to be a primary inflation hedge. For that, you typically look at investments like Treasury inflation-protected securities, TIPS, or a diversified stock portfolio. Don't fall into the trap of thinking a CD is an inflation-proof investment. Its value lies in its safety and predictability, especially for short to medium-term savings goals where market volatility is unacceptable. Understanding this distinction is vital for a balanced financial plan, because misinterpreting a CD's role can lead to costly mistakes in your broader investment strategy. Here's what happens if you make another common mistake: needing to withdraw early from a CD. Let's say you put $5,000 into a 3-year CD, paying 4.5% APY. But 6 months in, an unexpected expense like a car repair or medical bill hits, and you need that money. Most banks impose an early withdrawal penalty, often a forfeiture of several months' worth of interest. For a 3-year CD, this can mean losing 6 months to a year of interest. If you had earned $112.50 in interest in those 6 months, the penalty might wipe out all of it and even dip into your principal if the penalty is severe enough. This is why it's crucial to only invest money in CDs that you won't need until maturity. An emergency fund, typically 3 to 6 months of living expenses, should always be kept in a highly liquid account like a high-yield savings account, not in a CD. The CD ladder helps mitigate this somewhat by providing annual access to a portion of your funds, but it doesn't replace an emergency fund. Ready to set up your own successful, non-callable CD ladder? Here are your concrete action steps. First, calculate your total investment amount and decide on your ladder structure, e.g., 1 to 5-year rungs. Second, research current CD rates from online banks and brokerage firms, specifically looking for unknowingly CDs. Tools like bankrate.com or NerdWallet can help compare rates. Third, open accounts with the chosen institutions. Fourth, purchase your initial set of CDs for each rung of your ladder. Set calendar reminders for each CD's maturity date. And fifth, when a CD matures, immediately reinvest the principal and interest into a new long-term CD at the longest rung of your ladder, always checking for the non-callable status. This disciplined approach will ensure you're always optimizing your returns and maintaining flexibility, protecting your money from future rate surprises. But there's one final consideration for maximizing your returns. By now, you understand the critical difference between callable and non-callable CDs and how to build a robust CD ladder that truly works for you. Avoiding that single mistake could save you thousands by 2026 and beyond. This strategy balances safety, liquidity, and competitive returns, making it an excellent choice for a portion of your portfolio. If you're wondering how CDs compare to other safe havens like money market accounts or high-yield savings for your emergency fund, you want to watch our next video on that topic. It dives deep into the pros and cons of each. Don't forget to subscribe for more actionable personal finance insights that can truly transform your financial future.